Okay, in sixth unit, we discuss about the short-term money. Regarding to the short-term money, that is money market. Money market is deals with several general topics. That is um, T-bills and ma- So in money market, we discuss about the T-bills, certificate of deposits, and some commercial paper. And in what way we can get within short period, what way we can get the money. Like we discussing about in particular money market chapter. Then after foreign capital, how we can raise the money from the foreign institutional investors and through foreign direct investments, how we can get the money from foreign investors. That thing also we discussed in unit number 7. So up to this units we discuss about the how can we raise the money and how we utilize that money to particular organization or establishment of any industry or company. So then what in how many ways to raise the money, and then after how we can utilize for particular effective utilization of money to maximize the shareholders wealth. That particular purpose we discuss about up to two blocks, that is financial markets and introduction to the business finance. Now coming to the regarding to the financial decisions. In this particular financial decisions, financial manager or particular organization financial manager, what he can do means he raise the money to in how much percentage he can raise to benefit the particular shareholders or investors. So in what percentage it is beneficial to the equity shareholders? It is depending upon the some constraints and investment criterias. So just we discuss in what way the reduce the cost of capital of particular organization. It is depending upon the so many factors. That is how much percentage we raise the money from the outsiders. That is bank loans or other issuing of debentures to the general public. So likewise, in how much percentage we take the money from outsiders, and also how much money we collect from the equity shareholders, that owners in owners point of view. So in what way the particular owners will get the more benefit, in which combination it will be more benefit, that will be discussed in this particular cost of capital unit. So just see the definition regarding to the cost of capital. The cost of capital is nothing but the rate of return the firm requires from the investments in order to increase the value of the firm in the marketplace. It is nothing but it is a minimum rate, minimum required rate of return. So cost of capital is nothing but it is a minimum rate of required rate of return to maintain the stable market price of the particular share, particular company share value. So if it is if particular company get more profits, then that behind that particular fixed interested shareholder fixed interest amount, after paying off the interest to the particular debenture holders or bank loan to the it is a very it is in fixed nature. So after completing of interest thing, then remaining amount it will be useful, it will be distributed to the equity shareholders. Once it is particular profit is arrive more than the fixed interest payment, that value it more than we particular company get the profit, then only the market value of the particular share will be stable, or it will be increased. Then automatically equity shareholders value also increase. So cost of capital is nothing but it is a minimum required rate of return. Okay. So according to the according to the Jane H J. So the cost of capital is minimum rate of return, which is firms which is a firm must and expected to earn on its investment so as to maintain the market value of the share. The cost of capital is not a cost as such. So cost of capital is not a cost. It is a minimum required rate of return, and it comprises of three components such as normal rate of the return at zero risk level, the premium for the business risk, premium for the finance risk. This just see this difference between these three terms. Normal rate is nothing but if any investor or uh, any loan given to the particular company, that particular person, what they think, if I invest this money into particular bank, how much rate of return the bank will be paid. It may be around 8% or 7% is very depending upon the market condition, depending upon the RBI norms and all those things. That is a fixed rate, that is a minimum rate. Uh, Minimum rate is nothing but there is a particular investor, they don't take any risk. There is not involved any risk. So that we call as normal rate of return. In this particular situation, there is no risk to the particular investors. Coming to the business risk, if any investor want to invest in a some amount in particular business organization, what he will take some business risk. It means the particular that return is depending upon the business, a particular company business activities. That particular organization doing well, then they are that particular company getting good profits in over number of years. So the if it is what investor they think, they think that in coming after investment of this money, my money into this particular company, then he will also get some earlier what, but that particular company getting returns, that amount also he will get. Likewise he think and he invest, so he is taking some risk compared to the earlier invest into the bank. So coming to the business risk is he takes some risk. So finance risk is nothing but uh, after some equity shareholders, they are invest some money, they are investing their money into particular company, where they think if that particular company is doing very well, and then it will be continue their profits in coming years also. So based on the situations, that profits also increasing and share value also increase, that the reason they are investing particular company. So this is we call as financial risk. uh, why it is important, cost of capital, why we learn, or why it is important to the any organization or any financial manager, why it is important means, first thing is it is designing the cost capital structure. First, why we learn, or why we discussing about this capital cost of capital means, capital structure is nothing but if any organization needs 100 crores, for example, if any organization they needs 100 crores, it means this 100 crores, they given the equal rights or equal ownership to the equity shareholders. One choice. Second choice is 50% is debt capital, or 50% is equity capital. This is a second option. Third one is 50% is equity share capital, 30% is in issuing the debentures, 20% of required share amount is issued collected from the bank loans. So it is depending upon the how much percentage of how much controlling power, it will be depending upon how much controlling power take in the hands of the particular owners of the company. Okay, it is based on the particular cost of capital, we get how much debt holders get the return, how much equity holders they will get the return. So it will be depending upon the capital, how much it is depending upon the capital structure. Then after the capital budgeting decisions. In capital budgeting decisions means, if any company want to purchase any new mission, or upgrading to the new technology, or establishment of new industries in different locations, it will be depending upon the how much money in particular organization, how much money they have. So how much money they are collecting from the outside, it will be depending upon the so many factors. So in which way we collect the money from outside and we can invest in particular organization, and it is how it is beneficial to the particular equity shareholders, how they are our market price will be increased. It is so based on this cost of capital, we take the 3 or 4 options. In that particular option, how much gain we are getting through, in what way we invest that particular money in particular in any purchase of any fixed assets are like. So it is depending upon the how much we repaying. It is depending upon that particular repaying situation. So that purpose also we are discuss the cost of capital comparative study of source of financing. So so for comparing the in which source, how much percentage of we are paying in which, in equity shareholders how much we are paying, in preferential shareholders how much we are paying, and we through debt and how much percentage we are paying. It is depending upon the uh, different sources we compare based on the, if bank loan taken, how much percentage they are giving, how much percentage of they given to me for their money given to organization, and we repay like interest through interest way, how much it is. It is depending upon, we can have a choice to compare this like this cost of capital situation. Just the source which bears the minimum cost of capital would be selected. Although cost of capital is important factor in such a decisions, but equally important are the consideration of the retain, controlling, and avoiding the risk. So entire amount is equity fund. It will be distributing our ownership rights to in different persons. So compared to equity shares, we take the money from banks or uh, uh, other loans. So we pay the interest amount. Then after some period, we repay the entire amount to the particular loan amount. So based on this thing, we can evaluate the financial performance. Based on the cost of capital, we can evaluate the how much profit this in particular financial year we are get, and the previous year how much we are get. So we can compare is the we can evaluate the performance of particular organization through the cost of capital, knowledge of the firm and expected income, and inherent risks. So through this cost of capital, we can calculate the how much capital we are invest for the particular organization development purpose, and how much return we are getting. So we can have a we can know the how much return we are getting. So because of this cost of capital. Sixth one is financing and dividend decisions. Based on this cost of capital, so initially we prepare one capital structure. So that particular capital structure situation, how much we are paid to the debenture holders, and it will be fixed in before distributing to the equity shareholders. These are all the main importance to the cost of capital. This is the reason we learn the cost of capital. So classification of cost of capital. So here some definitions given to the in particular we are using some uh, we are using some words in particular cost of capital, that is historical cost, future cost, specific cost, and composite cost, average cost, marginal cost, explicit and implicit cost. So historical cost is nothing but it is a past how much we historical cost is nothing but it is already occurred, it is already happened. So based on the past situations, how much we are incurred, how much we are paying to the loan holder loan holders, and also equity shareholders, how much we particular organization performance, we can see the past performance. Okay, coming to the future cost. Future cost is nothing but it is like expected cost of the funds to be raised for the financing projects. So future cost is nothing but how much cost we incurred for the for furthermore to invest, or furthermore we elaborate our organization and establish new industries in different locations. It will be depending upon the past performance. If future cost is nothing but we cannot uh, pay the money, but we can expect to how much we can incurred in future based on the past performance and past cost, that is historical cost. Specific cost and composite cost. Specific cost is nothing but one particular thing, how much percentage, how much we are getting the cost, we call as a specific cost. Combined cost means all combined cost is various sources of finance. We are how much we in different sources, how much we are paying, that include in this particular composite cost, we call as composite cost. Then average cost. Average cost is nothing but it is a capital reforms to weighted average cost of capital calculated on the basis of cost of each source of capital, and weights are assigned to the ratios their share of the total capital funds. Marginal cost is a capacity uh, may be defined as the cost of obtaining another rupee of new capital. So average cost is nothing but if we are raise the money from different sources, in which source we are getting, for example, we are getting it from equity source, we are getting 50%. From debenture holders, we are getting 30 percentage, and 20 percentage we are getting from the bank loan. So 50 percentage means half of the portion we raise the money through equity shareholders. That weight is 50%. That means 5 points. And debenture holders, we are raise the money in 30 percentage. It means we are given to 3 weights. And last one is through bank loan, we are getting the amount from 20%. It means 2 weights. So likewise, in what percentage, in what way we are getting the money, it is depending upon our requirement. And also average cost means all three sources we combined, and then we see that we call as average cost. Next one is marginal cost. Marginal cost is nothing but for another rupee, another amount, extra amount we collected. So in west we get the extra amount, how much of cost we incurred for get the more extra amount from the outside, we call as marginal cost. Explicit cost and implicit cost. Explicit cost means nothing but it is a uh, out of pocket cost. It means how much we are paying to organization is paying to outsiders, how much percentage organization is paying to outsiders, we call as, it means out of pocket, we call as explicit cost. Implicit cost means how much we are getting, how much interest we are getting, particular organization is getting. It is uh, inside of the money. Explicit cost is nothing but how much we are paying, how much organization is paying, that we call as explicit cost. How much we are getting means we call as implicit cost. Uh, so some factors is determine the forms of cost of capital. So any organization, some factors it is influenced to get the data, how much we collect from different sources. It is depending upon some external factors. That factors are general economic conditions. The second one is market conditions. Third one is operating and financing decisions. Fourth one is amount of financing. So these four factors will decide the how much cost of capital, how much percentage we get the outsiders, how much we get the from equity share, from owners. It is depending upon the economic conditions of particular location or a particular organization, and market conditions. So it is also depending upon the market conditions, how much we are getting from outsiders and equity shareholders. Operating and financing decisions. If you have more controlling power, we can kept the more equity share percentage for decision making purpose. So likewise, it is depending upon the economic and market conditions, and also operating, and how much amount we are financing. It is depending upon these four factors. uh, it is determine the cost of capital. Problems with the determinants of the cost of capital. So we get the money from different sources. So we calculate the how much percentage we are paying into outsiders, and how much we are in profit, how much we are paying to the equity shareholders. So it is not possible to the any financial manager or any uh, accountant. There is have we cannot predict the this much is not enough. So uh, in cost of capital also we can have some uh, problems and determinations that is controversial regarding to the dependence of cost of capital upon the method and level of financing. So which method we are using for calculation of how much percentage we are raise the money from different sources? It is purely depending upon the which method is we are using. Second one is computation of the cost of equity. How much equity capital we are raised through issue the equity shareholder through the way of equity shareholders. So it is also a problem to the particular organization, and computation of the cost of retained earnings and depreciation funds. So how much we kept for the future purpose, and how much we are kept for the depreciation purpose. So it will be also influence the cost of capital. Then future cost versus historical cost. Earlier we discussed about the future cost and historical cost, and problems of the weights. Weights means how much weights we given to the equity shareholders, how much weights to be given to the debenture holders, and bank loan. So it is problem. It is which is very exact is no one can explain. So these are all the problems to the determination of the cost of capital. So just see the computation of the cost of capital. So here, how we can calculate the cost of capital? We have two methods. One is computation of capital cost of specific source of finance. Okay. Second one is computation of weighted average cost of capital. So we have two methods. One is specific source of finance. Second one is we assign the weights to average cost of capital. We have two methods to we are using for computation of the cost of capital. Okay. First one is just to see this example problem. We can understand the okay. There are two companies, namely X Limited and Y Limited. The capital of the X Limited is fully financed by equity shareholders, whereas Y Limited uses the debt fund as well as given below is the profitability statement of both companies. Here we have two companies, that is X Limited and Y Limited. So in X Limited, they are collect the money from, they are raise the money from equity shareholders only. Coming to the Y Limited, they are issuing 60% to the equity shareholders and 40%. So Y Limited use debt and as well as equity. So just see the earning before interest and tax. It means the actual profit of the particular we get the EBIT from trading and profit and loss account. In particular trading and profit and loss account, how much profit we are getting we call as EBIT. EBIT means nothing but earning before interest and tax. Before we are paying interest to the particular what we are getting the loan from banks or other outside, and tax to the government. Before we are paying to interest and tax to the government, we call as earning before interest and tax. So here X Limited and Y Limited is EBIT is 100 lakhs and 100 lakhs. Interest paid to the debenture holders. So here in first situation, X Limited has 100% they raise the money from equity shareholders. So there is no need to pay any interest to the outsiders. Coming to the Y Limited, they are issue the debentures to the general public. Then they get the money, and here that particular debenture holders, we pay the interest. How much we are paying here? 40% we are paying, 40 lakhs we are paying to the interest to the debenture holders. Then after profit before interest, before tax, profit before tax is for X Limited is 100 rupees and Y Limited is 60 lakhs. So for that particular earning, we pay the tax 35% to the government. That is 35 lakhs here, 21 lakhs. So profit after tax, X Limited is getting 65 lakhs and Y Limited is getting 39 lakhs. The comparison of the two companies shows that the interest payment of 40 by the interest, and so this is the problem. Just so here, based on the situation, which company is getting more, dep depending upon the equity position, depending upon the equity shareholders value, we can say that, for example, here 100 1 lakh equity shareholders we have, then how much we are getting, how much equity each equity shareholder get 6.5 rupees. Coming to this thing here, Y Limited 3.9 they will get. So we have three. We discuss the uh, four things, that is cost of debt, cost of preference shares, cost of to the return earnings, cost of equity shareholders. So in in each source, how much we are paying and in what way we are paying, and what is the formula for calculating this particular cost of debt and cost of equity, and different sources. So now first we discuss about the cost of debt, cost of long-term debt. So here we have two things. One is cost of redeemable debts, cost of debt. Irredeemable debt means in lifelong they will not get the what initially that particular investors they paid, that particular company will not repay to the particular investors, but they will get fixed rate of uh, debenture interest rate. Coming to the cost of co- coming to the cost of redeemable, means redeemables with after completion of the certain period, we repay the particular organization, repay the amount to the what initially the investor invest in particular organization, that amount repay certain period of completion of certain period. Cost of redeemable debt means you will not get entire life, entire company organization life will not get the initial payment of investment amount, we call as cost of redeemable debt. So just see the formula for calculation of cost of irredeemable debentures. The debentures which are not redeemed by the issuer of the debentures is known as irredeemable debentures. Cost of debentures. 1 minute. Hello. Hello, Abhay. So cost of redeemable debentures is nothing but the debentures which are not redeemed by the issuer of the debentures is known as irredeemable debentures. Cost of debentures not redeemable during the lifetime of companies is calculated as below. So here the initial issuer particular organization, he will not repay the what initially the investor invest in particular organization in lifetime, he will not get that amount, but he will get more rate of return for investing particular through irredeemable debentures way. For calculation of the interest for that particular irredeemable debentures, that is KD is equal to I by NP 1 minus T. KD is nothing but cost of debt after the tax. I means annual interest payment. NP means net proceeds of debentures or current market price. T means tax rate. So this is the formula for the cost of irredeemable debentures. So this is the formula for cost of redeemable debentures. Redeemable means after certain period, after completion of the certain period, the investors will get the amount what initially they invest, that amount he will get. So that thing we call as cost of redeemable debentures. That for calculation of cost of redeemable debentures value, we calculate like this using this formula, that is KD is equal to I plus RV minus N by N whole divided by RV plus NP minus 2 into 1 minus T. RV is nothing but redemption value of the debentures, and NP is net proceeds or current market price. So remaining is N is a number of remaining debenture years, and I is interest payment. So just we see in the coming slide we see the one problem. Then you will understand that what is the how we calculate the cost to the irredeemable debentures. Just see the problem. A company issue the 10,000 10% debentures of 100 each at par value on 1/4/2012 to be matured on 1/4/2022. The company wants to know the cost of its existing debt on 1/4/2017. When the market price of the debenture is 80 rupees, compute the cost of existing debentures assuming 35% of tax rate. So here is given initial in issuing date and maturity date. In 2017, what is the existing debt value? So he's asking about you calculate the cost of debt. So for redeemable irredeemable purpose, we are using this formula. Redeemable purpose, we are using this formula I into 1 minus T plus RV minus NP by N, RV plus NP by 2. So here I means interest on the debentures. So each debenture value is 100 rupees. It means in 100 rupees every year he will get the 10% of rate of return. So the interest rate for every year is in 100 rupees, 10% is 10 rupees. The current market price. So just see here, the current market, when market price of the debenture is 80 rupees. It means, so now
Sorry for disturbing.
yeah.
The problem screen is not coming on. The slide is not coming on the screen, sir.
1 minute, I will check and I will share once again.
Okay, sir.
Now it is appearing, ma?
Sir. Yes, sir.
Yes, sir.
It is clear, ma?
Yes, it is clear, sir.
Okay, okay, ma, okay. Okay. So this is the formula for calculation of redeemable cost of redeemable debentures, that is interest into 1 minus T plus RV minus NP by N whole divided by RV plus NP by 2. So I means interest rate. How much interest rate on debentures? That is 10% on face value. That particular face value, that particular debentures face value, that is 10 rupees. The market price is 80 rupees, and the redemption value, they are saying that redemption value is 100 rupees. That particular time period is 5 years. So using this thing, we calculate the cost of the debentures, that is 11.67%. So this is the main cost of the particular debenture value. So in examination point of view, you will not ask any problems, but for just understanding purpose, I am saying this problems. In business finance, they will not ask, but they will ask very little bit problems only. So just understanding purpose, I am saying these problems. Okay. So cost of redeemable preferential, 1 minute, preferential shares. So that is regarding to the cost of debentures. Second one is cost of preferential share capital. That is, the preferential share capital are paid dividend at a specified rate on face value of the preferential share. The payment of dividend to the preferential shareholders are not mandatory, but are given priority over the equity shareholders. The payment of dividend to the preferential shareholders are not charged as expenses, but treated as an appropriation of the profit after tax. Hence, dividend paid to the preferential shareholders does not reduce the tax liability of the company. Like the debentures, preferential share capital can also be categorized as redeemable and irredeemable preferential shares. So, just we discuss about the difference between the debentures and preferential shares. Preferential shares is not treated as expenses. In any in any company, they are issuing preferential shares to the general public, means they will not show into the uh, expenses in particular in profit and loss in expenditure account. They will not show into the, they will not get the reduction, they will not get the tax deduction, they will not get the tax deduction. But debenture holders, through issue the debenture holders, through our company will get the tax deduction. So there is the difference between the tax liability, only difference between the debenture holders and preferential shareholders. So here also we preferential share capital we bifurcated into redeemable preferential share capital and irredeemable preferential share capital. Okay, this is the formula for the irredeemable preferential share capital formula, that is PD by PO. PD means annual preferential dividend. PO means net profits from the issue of preferential shares. So just see the problem. If R Energy is issuing preferential stock at 100 rupees per share with stated dividend of 12 rupees and the flotation cost is 3%, then calculate the cost of preferential share. So here the particular on R Energy is issuing preferential share at 100 rupees. Then starting, they are giving the dividend to the 12 rupees every year, and floating cost is 3%. Floating cost is nothing but it is cost to the initially issuing the initial organization issue some amount of issuing purpose, organization get the some expenditure, so that we call as that floating cost. So then this is the using this formula we can calculate the cost to the irredeemable preferential share. That is net profits is after deducting the floating cost, we get the net profits, that is 97 rupees. The formula for this cost of preferential share, that is equal to PD by P0, that is 12 by 97. Then 12.37 is the cost to the preferential shareholders. This is the formula for the earlier we discussed that cost to the cost of debenture holders. Like same formula also we are using for this calculation of the this cost of redeemable preferential shares. But difference between the debentures and preferential shares, that is tax only the difference. So cost of equity share capital. So we have four ways to calculate the four five five approaches to we calculate the cost of equity. That is dividend price approach, earning price approach, growth approach, realized yield approach, capital asset pricing model, CAPM model. So using this five methods, we can calculate the cost of equity share capital. So this is the formula for the cost of equity, that is dividend by P0. That is D is equal to expected dividend and P is the market price of equity. So using these five methods, we calculate the cost of equity. Just coming to the next thing is computation of weighted average cost of capital. So earlier we used that what that is how in computation of the cost of capital, we see the computation of cost of capital of specific source of finance. Using specific source of finance means using debt fund, using preferential share capital, using retained earnings, and using cost of equity. So in specific source, how the cost of capital we incurred, we are calculating the earlier. Second method to calculate of cost of capital, that is computation of weighted average cost of capital. This is the second method to calculate the cost of capital. So these are all the steps to the calculation of weighted average cost of capital, that is determination of source of funds to be raised. So how much funds we are raising? First we determine how much we are raising from the different sources. Then computation of cost specific source of funds. So earlier we know we are see that in which source we are uh, in each source how much cost to incurred particular organization. So we combine the we compute the each source of cost, how much cost we incurred for the debentures, how much cost we incurred for preferential shares, how much cost we incurred for equity shares. So individually we calculate. First we determine how much money we are raising, issuing different sources of funds. Then compute the how much cost we incurred to calculate this uh, in specific source. Then after assign the weights, and for assigning the weights to the each source of funds, we have different methods to assign the sources. That is so this is the three ways to assign the weights, that is book value of weights, capital structure weights, market value weights. So then third step is assignment of weights to the each source of funds. Then multiply the cost through weights. So earlier we in how much percentage we are getting from each source. Then we assign the weights to the particular source. Then we multiply the that source amount with the weights. Then the last step is add the individual source weighted cost to get the cost of capital. Then we can see one problem. Then you will understand what is the way to calculation of the weighted average cost of capital. So this is the problem for problem. That is, the following details are provided by the GPS Limited. That is, equity share capital is through equity share capital that the particular GPS Limited is raise the money 65 lakhs, and 12% of preferential share capital GPS Limited is raised 12 lakhs. Then after in 15, they are issuing the 15% redeemable debentures, that is 20 lakhs. 10% convertible debentures is 8 lakhs. So GPS Limited is issuing different sources, different. They are collect the money from different sources. That is, they are using four methods, four sources. That is equity shareholders and preferential shareholders, redeemable debentures, and convertible debentures. In these four ways, GPS Limited is raise the money. So what he is asking, the cost of equity capital for the company is 16.30, and income tax rate for the company is 30%. You are required to calculate the weighted average cost of capital of the company. So this is the four ways. In four ways, GPS Limited is collect the money. Just see this how how we are calculate the each source cost. For equity shareholders, this is the values, and preferential shareholders, like these values we are taking from this here. So total we collect the 1 crore 5 lakhs from these four sources. So in this particular 1 crore 5 lakhs, we get the 65 lakhs from equity shareholders, 12 lakhs from the preferential capital, 15 lakhs from the debentures, and 10% from 10% issuing the 10% convertible debentures from 8 lakhs. So likewise, we collect the 1 crore 5 lakhs. So for 65 lakhs, in how much percentage in 1 crore 5 lakhs, in 65 lakhs is how much percentage? Means 61.9% we raise the money from equity shareholders. Then we how we this value we will get means 65 lakhs divided by 1 crore 5 lakhs, the 5 lakhs, then we will get the this this percentage value, this value. Likewise, in preferential share capital also, 12 lakhs divided by 1 crore 5 lakhs, then we will get this value. Likewise, we calculate the weights using how much percentage of in particular total capital. This is the weights given to this particular value. Then cost of capital after the tax for equity shareholders cost already they given, that is 16.30. For 12% preferential share capital, we calculate using earlier formulas. That is using that just see the here cost of convertible debentures, average cost of capital. So that is 12.120. For 15% redeemable debentures, calculation formula is 15 into 1 minus tax, then we will get the 10.5%. That is this value, and the cost of 10% convertible debentures value is like this 0.070. Then after we multiply this value and this value, then we will get the weighted average cost of capital. Overall weighted average cost of capital of particular RBC Limited is 0.1399. Okay, this is the total cost of capital. So up to this, we completed the cost of capital, and coming to the next chapter, that is cost capital structure. Capital structure is nothing but capital structure is nothing but in liability side we find the equity share capital, preferential share capital, debentures value, then after long-term loans. This entire thing we call as capital, entire thing we call as long-term source of funds. So in which percentage are it is more, in which percentage is more profitable, in which in what way we collect the money, it is beneficial to the organization and it is beneficial to the equity shareholders. It will be decided by using some capital structure theories. That is, now we have four capital structures, that capital structure theories, that is net income approach, net operating income approach, then after traditional approach and approach. So in our topics we have four capital structure theories, that is net income, net operating income approach, and traditional approach and approach. So this is the main difference between the cost of capital structure and financial structure. So this thing we will discuss in next week. Okay, thank you everyone.
సార్ ఇంపార్టెంట్ క్వశ్చన్స్ చెప్పండి సార్ ఒకసారి.
ఓకే మా, ఇప్పుడు మనకి నెక్స్ట్
వీక్ ఒకటే ఉంటుంది సార్, ఇంకా క్లాసెస్ ఉండవు అంటున్నారు. నెక్స్ట్ వీక్ ఒకటే ఉంటుంది అంటున్నారు. అందుకనే ఒకసారి ఇంపార్టెంట్, ఇంకా చాలా యూనిట్స్ ఉన్నాయి కదా, అందుకనేసి ఒకసారి ఇంపార్టెంట్ క్వశ్చన్స్ చెప్తే మేము కానీ ప్రిపేర్ అవుతున్నాం. అందుకని
ఓకే మా, ఓకే మా. ఎవ్రీవన్ ఈజ్ కంఫర్టబుల్ ఇన్ తెలుగు? Okay, okay. I will tell you in both languages. One is Telugu and English. ఓకే, ఏం లేదమ్మా, ఇప్పుడు బుక్లో మనకు మొత్తం ఉన్నదంటే మీరు ఒకసారి మీ దగ్గర బుక్ ఉంటే ఒకసారి లాస్ట్ చాప్టర్ తీయండి, లాస్ట్ పేజెస్ తీయండి. లాస్ట్ పేజెస్లో మీకు ఒకటి మోడల్ క్వశ్చన్ పేపర్ ఇచ్చారు చూడండి ఒకసారి.
అవును సార్.
మోడల్ క్వశ్చన్ పేపర్లో ఏంటంటే తను మొత్తానికి కూడా 10 క్వశ్చన్స్ ఇస్తున్నాడు వాడు. అవి షార్ట్ క్వశ్చన్స్ 10, లాంగ్ క్వశ్చన్స్ 5 క్వశ్చన్స్ ఇస్తున్నాడు. అంటే 5 క్వశ్చన్స్ ఇస్తున్నాడు, దాంట్లో ఇంటర్నల్ చాయిస్ ఇస్తున్నాడు. ఓకేనా? ఇక్కడ ఏంటంటే లాంగ్ క్వశ్చన్స్కి వచ్చేసరికి ప్రతి యూనిట్ నుంచి ఒక క్వశ్చన్ ఇస్తున్నాడు అమ్మా.
ఓకే సార్.
ప్రతి యూనిట్ నుంచి ఒక క్వశ్చన్ ఇస్తున్నాడు. సో మీకు ఇక్కడ ఏంటంటే థియరీ సబ్జెక్ట్స్ ఏవే ఉన్నాయో ఒకసారి చూసుకోండి. దాన్ని బేస్ చేసుకొని ఒకసారి నేను నెక్స్ట్ క్లాస్ చెప్పినప్పుడు ఏం చెప్తానంటే ఇంపార్టెంట్ క్వశ్చన్స్ అని చెప్పడానికి అని కాదు, కానీ ఇక్కడ మీకు ఫస్ట్ కంటెంట్ చాప్టర్ ఏదైతే ఉందో కంటెంట్ చాప్టర్లో మీకు ఇక్కడ కనిపిస్తున్న ప్రతి వర్డ్ యొక్క డెఫినేషన్ నేర్చుకోండి అమ్మా ఫస్ట్. అంటే బిజినెస్ అంటే ఏంటి, ఫైనాన్స్ అంటే ఏంటిది, ఫైనాన్స్ ఫంక్షన్ అంటే ఏంటి, సో క్యాపిటలైజేషన్ అంటే ఏంటిది, ఫైనాన్షియల్ మార్కెట్స్ అంటే ఏంటి. సో ఒక్కొక్క దానికి కంపల్సరీగా డెఫినేషన్ నేర్చుకోవాలమ్మా. డెఫినేషన్ నేర్చుకున్న తర్వాత ఫస్ట్ మీరు ఎగ్జామ్ రాసేటప్పుడు ఎప్పుడైనా సరే కానీ ఏ విధంగా స్టార్ట్ చేస్తారంటే, ఒకసారి ఇక్కడ ఒక క్వశ్చన్ ఇచ్చారు చూడమ్మా. ఫస్ట్ 11th బిలో వాట్ ఈస్ ద కాన్సెప్ట్ ఆఫ్ క్యాపిటలైజేషన్, డిస్టింగ్విష్ బిట్వీన్ ది అండర్ క్యాపిటలైజేషన్ అండ్ ఓవర్ క్యాపిటలైజేషన్. సో ఇక్కడ ఏంటంటే అసలు క్యాపిటలైజేషన్ అంటే ఏంటిది, డిఫరెన్స్ బిట్వీన్ అండర్ క్యాపిటలైజేషన్ అండ్ ఓవర్ క్యాపిటలైజేషన్, ఈ రెండింటి మధ్యలో డిఫరెన్స్ ఏంటి అని అడుగుతున్నాడు వాడు. సో ఫస్ట్ ఏంటంటే డెఫినేషన్ రాస్తాం, అసలు క్యాపిటలైజేషన్ అంటే ఏంటిది అని రాస్తాం. అట్లాగే ప్రతి యూనిట్లో ఉన్నటువంటి మెయిన్ టర్మినాలజీ ఉంటుంది కదమ్మా. అంటే కాస్ట్ ఆఫ్ క్యాపిటల్ కావచ్చు, ఫైనాన్షియల్ మార్కెట్స్ కావచ్చు, తర్వాత క్యాపిటల్ మార్కెట్స్, మనీ మార్కెట్స్, ఈ విధంగా ప్రతి దానికి డెఫినేషన్ నేర్చుకొని ఫస్ట్ డెఫినేషన్తో స్టార్ట్ చేసి తర్వాత వాడు ఏమడుగుతున్నాడో అవి వాటి గురించి కొన్ని డీటెయిల్గా రాస్తే మీకు మార్క్స్ పడడానికి అవకాశం ఎక్కువ ఉంటుందమ్మా. నెక్స్ట్ క్లాస్ చెప్పినప్పుడు నేను కొన్ని ఇంపార్టెంట్ క్వశ్చన్స్ చెప్తానులే, అప్పుడు చూద్దాం. ఓకేనమ్మా? అప్పటి వరకు కొన్ని నోట్ చేస్తాను నేను. ఓకేనా తల్లి? ఒక్కొక్క చాప్టర్లో ఏవేవి ఇంపార్టెంట్ ఉన్నా నెక్స్ట్ క్లాస్లో వచ్చినప్పుడు నేను చెప్తాను, సరేనా?
ఓకే సార్, థ్యాంక్ యూ సార్.
ఓకేమ్మా. ఓకేమ్మా. ఓకే, థ్యాంక్
హలో
యూ.
సార్.
యా 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 టెల్ మీ షబీనా.
మీరు ఇది పీడిఎఫ్ పంపిస్తారా? మాకి లింక్ ఏమున్నది?
Just you speak in English, no problem. I will understand now. Tell me. Just
Can you please send the PDF link today?
okay ma. Okay ma. After in next week I will send to you. Okay.
Okay sir.
Okay ma. I will okay ma. Next week I will give you some important questions and this entire PPT slides. Okay na ma.
Okay sir. Thank
Okay.
you.
Thank you. Thank you. Thank you, everyone. Thank you, everyone.